Parks Capital, where education plus investing equals success.
Happy New Year, everyone. I hope you all had a great holiday season. I am your portfolio manager, Rajiv Dixit, and welcome to the Market Outlook video for the first quarter of 2022. Wow, 2022. It feels like the year 2021 just flew by. What a year it has been. There was nothing ordinary about this year. Whether it was the unprecedented global vaccine initiative or the epic rise and fall of meme stocks, the year that started with a dramatic change of guard in Washington could only end with no change at all in your taxes. Who would have thought of that? While there are many things that 2021 will be remembered for in history books, one that should matter the most to long-term investors is the story of the rise in inflation. At the start of the year, inflation was at 1.36%. But by the end of the same year, inflation was at 7%. That, ladies and gentlemen, is over 500% change in the inflation rate over just 1 year. 500%. So, the question we should ask ourselves is, how did we get here? In my opinion, there are three factors that played a major role in this inflation disaster. One, excessive demand. That was a result of unprecedented federal and monetary stimulus injected into the global economy to recover from the pandemic. Two, limited supply, due to the supply chain and labor shortage issues caused by the forced economic shutdown. And three, the constant state of denial that Federal Reserve and other central banks chose to be in the year 2021. While the 500% rise in inflation rate was shocking both to market participants and economists worldwide, a ray of hope started to emerge in the later half of the year. In July of the year, when inflation was 5.6%, it was clear that the Federal Reserve was no longer confident to stand behind its inflation is transitory stance anymore. Slowly, over the last 2 quarters, Federal Reserve Chairman Powell did a remarkable 180-degree pivot that took the central bank into a completely different track of rate hikes and monetary tightening. The goal of containing the beast of inflation seems to have taken a primary stance in the halls of Federal Reserve yet again. Other pressures on inflation have also started to show a ray of hope. Federal Reserve's recent pivot and the general lack of appetite in Congress for new stimulus programs indicate that demand problem would no longer be worsened by government interventions. Pressure on the supply side of inflation are also starting to show hope. The labor market pressures are slowly showing signs of easing as people are more willing to return to work after vaccinations and the expiration of their unemployment benefits. Governments worldwide have also started to show reluctance towards using an economic shutdown as a measure of dealing with the recent surge of the Omicron virus. Thus, there is more confidence in the market that supply chain disruption problems won't become worse anytime soon. I purposely call these rays of hope because till now, there is no real improvement in inflation or labor force participation levels. But with all these positive signs, it is likely that the inflation pressure will start to ease into this year and beyond. While there is no one that believes that inflation levels will go back to pre-pandemic rates anytime soon, a relief in inflation pressures does ease the concern most market participants had all through 2021. By the end of the year, almost everyone in the financial markets, present company included, was starting to get defensive in the market due to the uncertainty around the inflationary problem. As I've stated before, no one wants to relive the high inflation eras of 1970s and 80s. This pivot or corrective action by the Fed is no small change. While I strongly believe that it will help us get off the course of the disastrous hyperinflation scenario, it also comes with higher interest rates and thus higher level of volatility in the near term. Specifically, the market now expects the Federal Reserve to increase interest rates 3 times this year and another 2 times in 2023. In addition, the Fed is expected to wind down its bond buyback program completely by March of this year, much earlier than initially expected. If you missed it, please see my detailed explanation on the bond buyback program in the last quarter's Outlook video. The normal effect of such tightening action by the central bank is the slowdown of the economy. As rates go up, money becomes more expensive, and thus less money is spent on goods and services. Some market participants are currently raising concerns of such an economic slowdown due to the Fed tightening. I would submit to you that these times are anything but normal. Those market participants who are taking the default negative outlook of the equity markets based on history are missing key distinguishing factors of our current times. Allow me to make a case of why this time the outcome could be very different. 1. As I've said before, coming into the Fed pivot, the biggest market concern was the rising tide of inflation. I would argue that many participants were holding back on making investments into equity markets because of their concern around the negative effects of hyperinflation. That pressure is relieved by this move from the Federal Reserve, thus making it much easier to allocate cash into equities where valuations are still reasonable. 2. Assets parked in money market funds is a good barometer of future market trends. Historically, if there is very high levels of cash parked in money market funds, eventually it makes its way back into the equity markets. Currently, thanks to the unprecedented federal and monetary stimulus, there is $4.3 trillion in money market funds. Cash levels this high had only happened twice in the recent history. Those times are January of 2003 and January of 2009. After both of those times, the equity markets ran up 15 to 20% for the next 3 years on average. What makes this even more interesting is the fact that in those 2 previous times, the levels were elevated because the market was coming off a recession. This time, the economy is healthy. The equity markets are at all-time high, and still there is record levels of cash that can flow into the equities and move the market higher. Third, while the US Federal Reserve has made necessary pivot to combat inflation, other central banks like the European Union have chosen to stay firm on the path of keeping rates low and providing more liquidity into their economies. This could have an interesting effect on the money flow in the US equity markets from abroad. Rates on US sovereign bonds would rise in comparison to other sovereign debt, and thus funds would flow into our economy for stability and yield purposes. 4. There's no place to hide. With inflation running at 7% and yields on bonds still averaging 2%, it would take a long time for investors in bonds and other debt instruments to see an attractive positive return on their money. If our assumption that inflation is not going back to pre-COVID levels anytime soon is correct, this scenario of low real yields will play out favorably for stocks in the near future. No one likes to earn a negative real return on their hard-earned money. 5. The economic reopening recovery is just getting started. While we've made a lot of progress in the past year, the reopening process is still very much related to the fear of the pandemic. Slowly, things are coming back to normal. In fact, I would say many parts of the economy are just starting to reopen. Think about it. Things like travel, entertainment. This should provide more catalyst to the market in the near future. With all that being said, there is no disputing the fact that the ride from here on is going to be turbulent. In fact, it has been turbulent for the past few months. But that is to be expected. Let me explain this with an analogy. Think of it this way. If you had a heart problem, it's bad for you in the long term, right? Now, if you went through an open heart surgery to fix your problem, right after the surgery, you will feel weak. You are not going to run a marathon right after an open heart surgery, but in the long term, you will feel a lot better than before. What the Fed is doing with the pivot is no different than performing an open heart surgery on this economy that is suffering from the inflation problem. It is normal to be turbulent while this is happening, but in the long term, it is much better for our financial lives. Nothing here is normal. Thus, turbulence is to be expected. The market is repricing all this new information and events and thus gyrating in a sideways pattern. But as long-term investors, we need to keep our eye on the big picture and our emotions in check as we ride this turbulence to financial success. Talking of emotions, I have something for you in the noise section this quarter that directly relates to emotions and personal biases. There is no hiding from the fact that unfortunately our country is going through a huge political divide, which we have not seen for a very long time. It is natural to feel emotional and biased about your political beliefs and your values. It's natural to be nervous about the outcome of elections or certain bills passing in Congress. It is natural to be scared in these times. While we go through these emotional times, it is also important to remember that elections have no significant impact on the investment strategy of a long-term portfolio. That's right. Who is in power in Washington has no significant impact on your investment strategy. Today, what I'm putting in the noise section is the fear of the market impact of an upcoming midterm election or even a presidential election. Because it doesn't matter who wins, who loses from a long-term investment strategy point of view. It might matter in the short term. It might matter to us emotionally or politically. But from an investment strategy point of view, it has no significance whatsoever. It is just noise. And thus, there is no point in worrying about it. Based on everything we discussed today, it should be no secret that our view is that equities have a much stronger footing coming into this year. Our current strategy is to stay cautiously bullish and use this current market turbulence to invest in opportunities that would provide value in the long term. The bond market on an overall basis still looks weak. Our strategy is to allocate funds in types of bonds and income-generating investments that would provide a positive real return for the portfolio and also diversify the portfolio at an adequate level. Of course, as you know, our strategy has one primary goal: In the long term, when markets go down, our portfolios are designed to go down less than the market. Thus, the strategy's primary focus is still risk aversion. To illustrate that fact, let me show you one such instance where our strategy would start to get defensive. This is the weekly chart of the small cap index. As you can see, the markets have continued their sideways pattern that started in June of last year. This is a support line that seems to hold this market from falling any lower. If at any time this line is broken significantly, our strategy is designed to get more conservative on equities. Similar support lines exist on other types of equity markets as well. These support lines keep us unbiased and on course for our long-term objective. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we're seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or in our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parx Capital is managed based on who you are, and thus they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We are looking forward to talking with each of you in your quarterly meetings. Remember, education plus investing equals success.
Here at Parx Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.